Gold. For literally thousands of years, it's been the ultimate symbol of wealth, power, you name it. But let's be real, in today's world of digital currencies and crazy markets, does it still have a place? Well, that's exactly what we're going to dig into. We'll break down why this ancient treasure might just be more relevant than ever for a modern portfolio. So here's the core idea we're exploring. How do you get all the good stuff from gold? You know, the stability, the growth potential, without any of the old school headaches. I'm talking about no more worrying about storage, no security nightmares, no second guessing if it's even pure. It's all about getting the value with none of the weight. Okay, but before we jump into the how-to, we've got to talk about the why. To really get why gold belongs in a modern portfolio, you first have to appreciate its incredible, long-standing history as a way to hold onto value. And this quote from economist John Exeter, it just nails it. Think about it. Across all of human history, through every single culture, gold has been seen as valuable, period. No other asset, literally nothing else, can make that claim. It's got this universal, timeless appeal. And its journey is just fascinating, right? It starts out as the symbol of divine power in ancient Egypt. Then it becomes the actual foundation for entire empires, their currency, their taxes. Fast forward to the 20th century, and it's the backbone of the entire global money system. And then, boom, the 2000s hit and gold ETFs are launched, completely changing the game and making it accessible for regular folks like you and me. So whether it was the jewelry of a pharaoh or the gold bars in a central bank vault, its main job has always been the same: to protect wealth and pass it down through the generations. Now this is where it gets really powerful. This slide just perfectly shows what we mean by preserving wealth. Imagine you had 5,000 rupees back in the year 2000. If you just kept it as cash, inflation would have eaten it alive, leaving you with the buying power of about 1,000 rupees today. Ouch. But if you had put that same 5,000 into gold, today it would be worth around 154,000 rupees. That is a massive difference, and a fantastic example of how gold can be a serious shield against inflation. All right, so we've covered the history. Now let's get down to brass tacks. How does gold actually work inside a modern investment portfolio? To really get it, we need to look at a couple of fundamental truths of investing. Truth number one is pretty simple, but so important. No single investment wins all the time. It just doesn't happen. One year stocks are on top of the world, the next, it could be bonds. Just putting all your money in one basket is like betting on one team to win the championship every single year. It's just not a winning strategy. And hey, don't just take my word for it. Look at the data. See that highlighted column on the right? It ranks how different assets performed each year. And what do you see? In 9 of the last 16 years, gold was the #1 performer. You'll often see it shine brightest exactly when other things, like stocks, are going through a rough patch. And that brings us to our next big idea, the magic of low correlation. Now, that sounds super technical, but trust me, the concept is easy. Think about building an investment portfolio like you're building a sports team. You wouldn't want a team full of only star quarterbacks, right? You need different players with different skills. It's the same with your investments. You want assets that don't all move up or down in perfect sync. And this right here is where gold is an absolute superstar. This chart shows its correlation to stocks is negative 0.04. That is so close to zero, which basically means their movements have almost nothing to do with each other. When the stock market zigs, gold might zag, or it might just chill out and do nothing. It's that independence that really helps smooth out the bumps for your entire portfolio. Okay, let's look at some real-world stress tests. Remember the 2008 financial crisis? Stocks took a nosedive, down 53%. Gold? It shot up 37%. Or how about the COVID crash in 2020? Stocks dropped 38% in that initial panic. Gold actually gained 6%. The takeaway here is huge. When things get chaotic, gold has historically been that reliable, safe place to be. All right, so hopefully you're convinced on the why part. Now let's switch gears and talk about the how. How can you actually invest in gold today? Believe me, the options go way beyond just heading to a jewelry store. So this table breaks down the main ways to do it. You've got physical gold, but that's risky to store, and you're never 100% sure about purity. Then there are sovereign gold bonds. They're safe, sure, but they have low liquidity, meaning it's tough to sell them when you need the cash. Gold ETFs are fantastic, super pure, easy to trade, but you need a special demat account. And that leads us to the last one, the gold ETF fund of fund. It gives you all the safety and liquidity of an ETF, but, and this is the key part, you don't need that demat account. Yeah, this gold fund of fund, or FOF for short,
is what we're really going to zone in on. Because honestly, it's one of the simplest and most accessible ways to get gold into your portfolio today. So to really get what a fund-of-fund is, we first have to understand what it's built on, the gold ETF. The easiest way to think of an ETF is like a basket. This basket holds real, physical, 99.5% pure gold. And then shares of this basket are bought and sold on the stock exchange, just like you trade a share of any big company. Okay, so what's a gold FUF? It's simply a mutual fund whose only job is to buy those ETF shares for you. It's like a convenient wrapper. It lets you invest in that gold-backed ETF without ever having to open a demat or trading account. You can even invest in it through simple methods like a systematic investment plan, or SIP. And let's talk about safety, because this is a big deal. The gold that backs these ETFs isn't just sitting in a back room somewhere. It's regulated by SEBI, it's held by an independent custodian in super high security vaults, it's constantly audited by third parties to check the quantity and purity, and on top of all that, it's fully insured. It's an incredibly strong system built from the ground up to protect investors. So, all of this brings us to the smart, modern solution that kind of ties this whole story together, the wealth company Gold ETF FOF. So why this fund specifically? Well, it basically bundles up all the advantages we've been talking about. You get total flexibility to buy or sell whenever you want. You get the simplicity of investing through a regular mutual fund, no demat account needed. You tap into the resilience of gold as that historic store of value. And you get top-notch efficiency with lower costs and that guaranteed 99.5% purity. And it's always good to know who's steering the ship, right? This fund is managed by Niranjan Das, a real veteran with over 32 years of experience in the mutual fund world. That adds a serious layer of expertise and credibility. Now, let's be absolutely clear about the risks involved. You'll see the riskometer rates this scheme as high. Why? Because it directly tracks the price of gold. So whatever ups and downs the price of physical gold has, you should expect to see that reflected in the fund. It's that simple. And that really leaves us with one final thought. When you consider its incredible history of holding value, its knack for performing when other assets struggle, and now these super simple, modern ways to invest, well, isn't it time to ask yourself, should the world's oldest asset have a place in your modern portfolio?